Hi, everybody. Sean McCracken, news editor for Hotel News Now, here with Greg Friedman, managing partner and CEO of Peachtree Group. Tell me if I got that right, Greg, because I'm terrible with titles.
You got it perfect. So
All right,
thank you, Sean, for
excellent.
having me.
So the reason I want to reach out to you is obviously we're headed into a new year, and with new year comes optimism. And I'm just wondering how optimistic people should be about kind of the lending financing environment, since that's been a big stumbling block in the industry for a while now. So obviously, Peachtree, you guys kind of touched both sides of that equation. Um, so I wanted to get your take on just generally how the lending environment is shaping up heading into 2024.
Sure. I think there's reasons to be optimistic that we're going to have a much more robust lending environment in 2024 for especially for hotels and across not only hotels but all of commercial real estate. I mean, so there are reasons to be optimistic. On the reverse side, I do believe we're going to continue to have a lot of challenges across commercial real estate that will, ultimately impact our industry, the hotel industry. And, unfortunately, that is going to be a challenge on the capital market side in the sense that, although the Fed has now started to become, more predictable, which really means, I don't expect that rates will increase much further. If anything, potentially rates could come down, in 2024. I'm not as bullish that rates will drop as significant as, some of the other or some of the investment banks have predicted. But I think there is a higher probability rates will be dropping in 2024 than increasing. That's for sure. And because of that stability within capital markets, I do think it's going to make it a more viable lending market because it's going to allow traditional lenders to be able to start to come back into the lending side where they choose to. It's going to allow all investors on the equity side as well as the credit side to probably have a better way of gauging underlying valuations because in 2023, part of the challenge has been with the rise and really going back to 2022 when rates started increasing. It's just how do you value assets when you don't know where interest rates will end up staying long term, and that because where the 10-year treasury rate settles has a really long term impact to where cap rates will settle. And for instance, over the last decade, the 10-year treasuries averaged around 2.2%. Today, the 10-year treasury, and as we're talking right now, it's around 4.2%. So it's almost double what it's been on average. And when you look at that impact to the 10-year treasury rate, ultimately that has a huge impact to what the actual cap rates that you apply to all commercial real estate, including hotels. And so ultimately, having a more stable, interest rate environment, having a more stable and more predictable Fed is going to allow, I think, for more lenders to come back in the market. The other factor, another reason to be optimistic too, is when there is a more stable environment altogether, risk premium spreads, not only how you value, assets. So, because there's usually risk premium spreads added to, the 10-year treasury rate. And that's how people figure out, where, what is the right risk premium spread to, across the risk free rate being the 10-year treasury rate. And ultimately that's how you settle on your cap rates. But then as it relates to debt spreads, spreads tend to blow out when you're in a very unstable environment, an environment where it's not very predictable. And that's what we've had the last, 18 months, unfortunately. And as we get into a more stable
Mhm.
environment, I think debt spreads are going to start compressing as well, which, will bring down borrowing costs, even if the index rates, stay relatively flat. So I think there are reasons to be optimistic, and um, hopefully we'll have a more robust lending environment in 2024.
Yeah, I mean, I'm sure everyone would love to see the costs of borrowing come down to what we saw a few years ago, but in the absence of that, some amount of predictability and consistency would be a pretty nice consolation prize. So,
Exactly.
so I wonder. You brought up the likelihood of interest rates going down versus going up, and like you said, there are some people out there who are making big bets that it's going to go down and probably faster than people originally thought. In your mind, as somebody who can take kind of a holistic view of the market, like, is that necessarily a good thing? I mean, obviously, debt being cheaper is in a vacuum a good thing, but you'd have to assume if interest rates went down and they went down fast in 2024, that would mean that things are not going well in the economy, right?
That's right. That means if interest rates go down, as drastic as some people are predicting, most likely that means, we've hit not only a recession, but we've also, have hit a hard landing. So we're
Yeah,
experiencing something that may not be at the level of the GFC, or maybe ends up being at the level of the GFC. But I don't think it's going to be. I think there's so much liquidity still in the system. I think there's a ton of dry powder on the sidelines. So even if things did start to take a turn for the worse, you would obviously see interest rates drop, and I think a lot of that liquidity, all that dry powder across private equity firms that have been allocated towards commercial real estate would start to come into the system and help sort of stabilize the situation to a certain degree, but or at least as it relates to values of commercial real estate. And then I do think other for other industries too, there's enough liquidity to help keep things going. But I just don't. I mean, my base case is either we have no landing or we have a soft landing in 2024. And part of the challenge we're going to have is we're just entering a period of higher inflation. And so the Fed,
yeah,
for them to reduce, I mean, they've been. I mean, if they continue to hold true to their words, I mean, they're continuing to try to get inflation down to 2% a year, and it's going to be very hard to get it, to 2% a year is my prediction. So if that's the case, for them to start dropping rates significantly in 2024, they're going to really need to see inflation continue to moderate, which I think it will
mhm,
moderate at some levels, but it's not going to get to a level, or at least a sustainable level, because if as they start to reduce rates, I think that's going to cause capital to flow back into the system, which is going to cause more inflation, and that's not going to be, that's going to get them above that 2% rate very quickly. So, and that's part of the challenge, because I think the job market continues to remain healthy. So, I mean, I think most people that want to have a job can get a job still. I think you have just when you look across across all these different things that can drive inflation, like housing. We still have a housing shortage, and that's going to continue to put pressure on inflation. And with interest rates, if interest rates drop, all of a sudden that's going to cause a buying spree across housing, right? Like
mhm,
that's going to start
yeah,
spurring more inflation. More developers are going to build more homes because there is, a need for it. But there'll
mhm,
be probably an overbuild, and that's going to drive inflation. And
mhm,
we continue to have, just you look at oil and gas and things like that. We're still going to have issues there that are going to drive inflation. So I think there's enough. Unfortunately, there's enough factors that are going to drive inflation that to allow for interest rates really to drop significantly from where they are. I think it's going to be pretty challenging, but I do think rates can drop over time. It's just we're not going back to what we've seen over the last decade. We're probably going to end up somewhere in between where we were over the last decade when you look at the 10-year treasury rate to where we are now. And that ultimately means, unfortunately for commercial real estate, especially like multifamily, which isn't really what we're talking about today, it's detrimental to the underlying values of those assets.
yeah,
Fortunately, it's for hotels we tend to be less sensitive to where the 10-year treasury rate settles, just because
mhm,
we typically trade at cap rates of 8%, 7 to 9%. So we have pretty good risk premium spreads even at where we are today, where the 10-year treasury is around 4%. You still have a like 300 to 500 basis points of risk premium spread.
mhm. I'm curious. I mean, obviously, Peachtree, you guys have restructured a bit in recent years and kind of broadened your horizons. Like traditionally, a hotel investor lender with Stonehill, which has now been absorbed, and you guys invest in more things now. But beyond that, I'm wondering how have the last few years kind of changed your mentality or approach to lending or financing deals? Like, do you look at things any differently now than you did back in 2019?
We still use the same, like from an underwriting perspective and how we look at the business. It's still the same. Now we do take in consideration from a standpoint of just going through the pandemic. I think there's certain markets that we're probably a little bit hesitant to lend into today, just given
Mhm,
those markets. When you look at how they were performing pre-pandemic, how they're performing today, it's very different. And in some cases, some of those markets, over the last couple of years have performed extremely well compared to what they've done historically. And we question if that's sustainable long term, right? So we're a little bit
mhm,
cautious from some of that run up if it's truly, we really question if it's truly sustainable or not. That causes us to be careful in lending in some of those markets. But in general, we still apply the same principles that we've always applied in how we underwrite, the type of assets that we want, looking at the markets and what's driving demand and looking at the impact of supply in those markets. I will tell you, it's in a strange way, it's much easier for us today on the lending side today because you have less new supply getting built across our industry,
mhm,
right? Like supply is projected to grow at around 1% a year. Historically supply
mhm,
is growing at about 1.6% a year. So supply is projected to, for the next several years, projected to be well below what historically it's performing at. And so that's for us when we're, looking at markets, you have a lot of stability just from a standpoint of, not a lot of new supply coming in. And then you have obviously, at least from our view, for the next 5 years, we believe there's a lot of just secular trends that favor demand. So demand's projected to continue to grow at 2% a year or more for the next several years as we continue to recover coming out of COVID. So we're very bullish on the hotel space, but we're not really changing the way we underwrite credits other
mhm.
than, taking into consideration some, new factors that have come out of COVID, like, some of the markets that maybe overly benefited or some of the markets that have, that's continue to struggle on the recovery side.
Mhm. You mentioned earlier too, kind of hotels in the grander scheme of real estate asset classes, and well, there's positives and negatives about where commercial real estate is right now. I mean, how much do you think that hotels are really set to poise or to benefit from struggles in office? And I mean, is it really going to be that much more of a desirable asset class because things aren't rosy everywhere else?
I'm biased because
Yeah.
obviously we're heavily invest in hotels. So I would tell you,
Yeah.
yes, we are gonna benefit. But it is, I mean, if you think about it, office makes up, and I think roughly, today, you look at the current value of office and it's probably around 20% of the total commercial real estate ecosystem. And
Mhm,
so using office as an example, it's there's really a very limited trade to no trade in office. So those
mhm,
dollars, groups that were allocating to office as they were trying to be diversified, hotels make up roughly about 7% of the total commercial real estate ecosystem, based on the current valuation of hotels across commercial real estate, when you include multifamily too. So so we make up 7% of the space. So it's very easy for us to, so if additional dollars, came into our space, that would be super beneficial, and that would probably help. And even if it was only a couple of points that normally would go towards office but was allocated into hotels, that would be a huge tailwind to drive potentially some cap rate compression, but also drive values at some of the,
mhm,
for the hotels directly, obviously, because lower cap rates would increase value. So I do think we could benefit. I think on the lending side today, specifically, beyond, and that comment's really more on the equity side, but on the lending side, I will tell you, you're seeing it right now. You know, there's very limited capital in the market today, right? Like most traditional lenders aren't lending. 40% of the debt market is made, traditionally is made up of regional banks, community banks, national
yeah,
banks. I think it's been in the news, it's been in the press. Banks are under pressure. So 40% of the market is struggling to lend. The CMBS CLO market makes up probably another, call it 25, 30% of lending to hotels and so forth in a normalized environment. That market is well under pressure as well. So When you look at it, most of the typical channels are under extreme pressure to not lend altogether. Not, and it has nothing to do with our space. It's just
Yeah.
what's happening today. And so, with that said, you're finding that more capital, the capital that's left, more of that capital is wanting to go into hotels because we have really good asset level performance. So we don't have the secular distress you're seeing at the office side. We
Mhm.
trade at higher cap rates, as I talked about earlier. So we have less negative leverage because typically our assets trade and are valued at a call it a 7 to 9 cap. We're in that range, in some cases a little bit higher. And so, compared to multifamily, which, during the middle of the pandemic went in some cases below 3% cap rates. In most cases, they were around 3 to 4% cap rates. So in the current, interest rate environment where SOFR's, around 5.4%, and, the 10-year treasury is north of, 4%. I mean, people are upside down very quickly across multifamily, which makes up
Mhm.
35% of the total commercial real estate ecosystem. But when you start to look at different areas where it's really tough to lend into, like multifamily today, because of that negative leverage impact. You look at just industrial, which is probably another 15, 20% of the commercial real estate ecosystem. It has that same challenge as multi does with the negative leverage impact. So, those are very desirable assets at the asset level, but they have more balance sheet stress. So you are seeing, because of the balance sheet stress you're seeing with the negative leverage across those property types, coupled with the secular distress offices going through, the lenders that are willing to lend today, the majority of them are probably more inclined to go into hotels because we have good asset level performance. We have really good trends from a standpoint of just on a forward basis. You look at supply and demand. There's less supply getting built, and demand is way, or is at least projected to continue to remain very robust and strong for the foreseeable future. And
Mhm.
so, and we have good, as I mentioned, good, positive, leverage in our, within our ecosystem. So it's it is favorable from that perspective, but unfortunately, there's just less lenders lending. So I don't think
Yeah.
everyone fully appreciate what's happening.
I mean, do you think that the regional banks ever really come back in the form and fashion that they were before, or is it just the shock that we felt last year is going to kind of create a new normal for them?
I think it's been a process over the last 40 years, and obviously over the last 15 years coming out of the GFC. I mean,
Hmm.
they're going to come back and lend. It's just there's going to be, unfortunately, less banks
Yeah.
altogether. As we sit here today, we only have 30% of the banks that we had 40 years ago, and probably 5 years from now, we'll probably only have 50 or 60% of those banks that are still left. So banks will continue to be under pressure. Over the last 15 years, obviously 14 years, banks have been less inclined to lend to commercial real estate and to the hotels as well, but they were still lending to it. It just they weren't lending at the leverage points or the levels that they were previously, in most cases, because they were trying to be prudent, and they had a lot of regulatory pressure, and the regulators tend to really zone in on the commercial real estate book.
Hmm.
So I think it's just going they're going to continue to be pressured. And the one thing I think you're going to find, if we were talking 5 years from today, like looking into the future, I think you're going to find that the banks that are lending, they're going to be very focused on lending where they have huge depository relationships, where they have true partnerships and relationships with borrowers, where they're using them for other services that bank is offering, and they're not just going there to rent their balance sheet. And you're going to
Yeah.
find that a lot of the banks are going to start partnering, and because this has already been happening over the last 12, 13 years. And this is when we started our lending platform, we initially started by partnering with banks, and we still partner with banks today, where we go in and we'll originate a whole first mortgage loan where a bank is participating with us, and we're just holding the junior tranche of that loan. So we're holding that subordinate piece of that first mortgage loan, and it's very attractive for that bank because they don't have to deal with the asset management headaches, because in a lot of cases they're not set up to handle it. It's better for the borrower because they have a servicer of that loan, they have a lender of that loan that really understands their space, being the hotel space, and so we can really structure loans that make sense for the borrower, and we can, and when there's a pandemic or a great financial crisis, we can help navigate and help asset manage those loans and make it and do something that's reasonable for the borrower versus in some cases banks get caught up in all the regulatory pressure and so forth, and so they end up having to do
Yeah.
things that just don't make sense.
Competitive advantage there or anything. But I mean, was there have been like obviously a lot more alternative lenders entering the space, and do you think that that's going to be the vehicle for banks then broadly is partner with these other lenders who can kind of take some of that off their balance sheet?
I think so. I think that is the hands down, that is what is going to be the future of commercial real estate lending. So not only for hotels, I think it's going to be for pretty much all property types. You're going to see an aversion of for banks to go out and do whole loan lending themselves, and they're going to be inclined to, at least many of these lenders, especially the regional banks, to partner with groups like us and derive deposits through the relationships with groups like us that are private lenders or have a private
Hmm.
lending platform like Peachtree does through Stonehill, our private
Hmm.
lending platform.
So just to switch gears a little bit, obviously construction lending has been kind of the most challenged piece of the hotel lending environment. And obvious there's, the silver lining of that is that supply has remained muted and that helps the operational numbers and it makes things look nicer when you're trying to pencil a transaction. But do you think like what do we need to overcome that hurdle? Like what's going to bring back construction financing in a big way? Is it literally just we need lower interest rates or is it something a little more sophisticated than that?
We just need more lenders willing to lend, right?
Yeah.
So when you have more supply of debt capital and debt liquidity, it's going to find its way into construction. Construction
Hmm.
historically is viewed as the riskiest uh,
Yeah.
type of loan to make across any commercial real estate asset. So they tend to
And
be
that's
less
priced in,
capital.
yeah.
Yeah, exactly. So it's priced in. Now, I personally love, and for us on our lending platform here with Peachtree Credit, which is effectively Stonehill, we like to do construction loans because I think it's personally, our industry, new wins, right? Like, so when you
Mhm.
finance a new project, you're going to have an underlying asset, especially if you pick a viable location that is should perform extremely well, assuming you have the right brand, right location. And then you just look at it from a standpoint of a lender, we get higher spreads by doing a construction loan versus financing something that's existing with in place cash flows. And so ultimately, I always say the risk is mispriced because the performance tends to be just as good, if not better, than financing a stabilized asset, right? And so I personally like it. A lot of banks don't fully, and when I say banks, really, most financial institutions don't appreciate that piece because they look at the risk of, getting the project completed. But as we all know, there's ways to mitigate, construction risk.
Yeah.
And, I think we've done a good job of that historically as a firm.
Mhm. So I'm curious, there's been a lot of talk about kind of this wave of maturities in 2024, and obviously this is not it's something that we hear fairly often. But I'm wondering from your perspective, do you think that this is a real concern? Do you think this is overblown? Do you think this is something that we'll feel in pockets kind of like we did in 2023? I mean, where do you think that lands?
I think it is going to be the discussion of 2024 because we're seeing it real time. We're
Yeah.
working on several loans right now. These are cash in refinance loans where groups have assets where they have underlying loans maturing. The existing lender won't extend those loans, and these loans are maturing like right now as we speak. In the first quarter of next year, they've been working with their existing lender. These existing lender won't refinance. They're going out to the market. There's very few lenders. Peachtree is one of the few lenders still lending, and so they're
Hmm.
coming to us, and they're having to. In some cases, we can do refinancings that are neutral. In some cases, they're actually bringing in cash, pay down the loan to let it size appropriately for us to make that loan. And the catalyst of all this again is that wall of debt maturity. So the $1.9 trillion of loans that you keep hearing about maturing between now and 2026. I mean, it's real. Now, some of it will turn into, where lenders will do extensions, but across the commercial real estate landscape, it's been estimated that about half those loans are going to have trouble. The 1.9 trillion are going to have trouble refinancing due to insufficient cash flows, and given just the cost of debt where it's risen to. So if those loans mature today in the current interest rate regime, it's been a lot of analysts believe about half those loans would be in trouble or in jeopardy of being able to get refinanced without the injection of liquidity. So that's going to be a huge catalyst to drive groups to either potentially sell assets, which will
Hmm.
create opportunities for everyone to be able to buy assets, opportunistically. It will also create opportunities for us to lend groups that are buying assets, as well as, as those loans mature, we can help. So it should be a very active 2024, and I do expect the latter half of 2024 to be extremely more active than what we've experienced over the last 12 months.
Yeah. And obviously, a lot of that will be driven by the operating environment too, right? Because cash flows still seem pretty strong m- for the most part.
That's totally right.
So if I was somebody approaching you today about doing a deal, what general advice would you give me? Like, what's just the general advice you give when somebody picks up the phone and calls Peachtree?
Yeah. So if you approached me about a deal and you wanted to know if this was the right time to make an investment or not, I would tell you that it's these moments of uncertainty and dislocation is where usually you find your best opportunities, as an
Hmm.
investor in real estate within, especially within hotels. And we buy hotels as well and we develop hotels, but it's in these moments where there's, confusion and uncertainty, and most people aren't willing to be decisive and make investments is usually when you want to be making those investments.
Yeah.
And it goes back to the basics. I mean, our industry is very complex. I mean, you got an operating model, you got a real estate model, but at the end of the day, from my viewpoint, it comes down to brand, basis, location is super critical. Sustainability, those demand drivers within those locations where you're located, relative to the other comp set, as well as to the actual demand drivers. Uh, so I mean, and then you want to have the right physical plant too that's
Hmm.
sustainable through many cycles. So you have all those pieces together as you're making that investment, and you appropriately capitalize any forward renovations or near term renovations. You should have success. If you're thoughtful that way in your underwriting approach and you're buying in, again at the right basis, and you have the right brand and location and so forth, and it's been proven to work, and you can ultimately benefit as an investor if you remain disciplined, but you're willing to be decisive in this kind of market.
Yeah, for sure. A lot of focus on the fundamentals, right?
That's right.
So, Greg, that's all I had for you. You got any final words of wisdom you want to share today?
I think that's pretty much it. I would just tell you, it is a extremely challenging market to operate within, but
Hmm.
challenges create a lot of opportunities, and I really do believe 2024 will be one of the better years for commercial real estate and for the hotel industry from a perspective of anyone that makes new investments in 2024 should experience really good outcomes and returns down the road from those investments, just given the catalyst of just the loan maturities, as we talked about, that 1.9 trillion dollars of loans that are maturing between now and 2026, and a lot of that's front end loaded in 2024. And then you just look at all the capex needs across the hotel industry, because over the last 3 years there's been a lack of investment of capex dollars. Historically, about $7 billion a year is spent on capex projects across hotels, and the last 3 years I think it's on average been around closer to around like 2.5 billion. So I mean, there's
Hmm.
been a capex spend has been way under what it's historically been, and that's going to be another catalyst that's going to drive groups to have to potentially sell assets, and allow new groups that are buying assets to be able to buy them opportunistically. So I think it's going to be a very interesting environment, and I think there's going to be a lot of opportunities. So it should be pretty exciting for all of us.
Well, I hope your optimism bears out into reality going into the new year. Greg, I really appreciate you taking the time. This has been fantastic.
Yeah, thank you. We'll talk soon.
Hi, I'm Isaac Colazo, Vice President of Analytics at STR.
Hi, and I'm Jan Freitag, National Director for Hospitality Analytics for the CoStar Group. Tune in to our new show, Tell Me More, a hospitality data podcast.
It's a podcast on the global hotel industry, its current trends, what we're thinking about, and where the industry's going.
And we like to have fun with the data too. Find us on hotelnewsnow.com or wherever you listen to podcasts. Subscribe today.
This episode of the Hotel News Now podcast was recorded on December 8th, 2023, and edited by Sean McCracken. Go to hotelnewsnow.com for the latest industry news every day.